Welcome Gartner employees. I'm Brian Skinner, Certified Financial Planner. In the next video in our series on employee-specific benefits for people employed at Gartner is on the Supplemental Life Insurance benefit available to you through HR. Who is this video for? Really anybody that works at Gartner this is applicable for. It's a benefit that applies to everyone. It can be scaled up if you need more coverage, and as you make more or have more needs to protect, it really tends to matter quite a bit more than it does when you're just starting out. So, what is life insurance benefit at Gartner and how does it work? You can choose between two options when you sign up for the plan. And usually a lot of these benefits happen right when you first get hired, but you can change them once per year during the enrollment period through the Workday portal. You can choose between either a $50,000 flat benefit or a benefit that is 2 times your target income. Not just your salary, it's your target income. Gartner pays for the benefit, but any benefit value that's over the $50K flat benefit, you have to pay taxes on for the benefit that they give to you. So they have an internal cost for what this coverage is priced back to them at. You have to pay taxes on the value of that benefit. The reason why they do that, this is per IRS regulations, by the way. It's not that Gartner's being cheap on you by having you be taxed for the benefit. You want that benefit to be taxable to you. Because that means if, God forbid, something were to happen to you and you passed away, benefit itself would be tax-free to your beneficiary. And that's what you want with life insurance. When you see your pay stub, you'll see in the taxable income section of that pay stub, there's a little section there and you'll see the value of the life insurance being computed in that. On top of this core benefit, you can add what they call supplemental coverage. The max coverage you can have in total is $3 million. And that ranges anywhere from 1 to 8 times your target income. You can also insure your spouse for up to $250,000 and your kids up to $10,000. Let's talk about life insurance in general and why you were talking about this benefit to begin with. Life insurance is really, really important. We did another video on disability income insurance, and that's also really important for a few big reasons. The core part of financial planning, and that's really the only thing I focus on all day and really every day, is that risk management is not something that can be ignored. We have to identify what are the risks in your financial plan and what could potentially happen that if they did happen, totally upends the structure of everything. If you were to pass away, if you were to become disabled, those are 2 huge risks that could put your spouse, your family in a considerably disadvantaged financial situation in a big, big way. Your ability to earn a paycheck is by far your biggest asset for most people. As you age, it becomes less so, but it is by far your biggest asset for the majority of your working life. With your life insurance need in general, it will wax and wane as you go through different periods of your life. I'm 36, going to be 37 soon. I have a 1-year-old, and my benefit is really, really high right now. Right? So if something were to happen to me, my wife would need a cash infusion to replace my earnings for a long time, maybe pay for college. So right now, I have a lot of life insurance coverage. Maybe 20 years from now, 25 years from now, and my son is less financially, or hopefully not financially dependent on me at all at that point, then I maybe won't need the coverage near the level I have today. I can drop it down quite a bit. If we have more children, my need will just get higher. So it's reasonable to review your coverage on a yearly basis to say, is what I have still the right type of coverage for me? Am I paying too much for it? Do I need to drop anything? And those are decisions you can make every year. But when especially if you have little kids, minors that are dependent on you, a spouse that's dependent on you, your life insurance need is really high. It's probably a lot higher than you think it is. Think about what would happen if you were to pass away and your spouse got 2 times your target income, up to say $500,000. $500,000 is a lot of money, no doubt about it. But is it enough to replace all of your income that you'll make for the next 10, 20, 30 years of your working career and really make it so that your family's okay if you were to pass? Very likely not, right? So this is a topic that really needs to be taken seriously. How you qualify for this benefit? There's health screening, right? So it's minimal. I would call it what's called a simplified underwriting. You would provide a statement of good health. MetLife is the company behind this benefit that's actually providing the insurance. Simplified underwriting through this SOH, as they call it, Statement of Good Health, is really simple. They ask you, a dozen questions or more, but it's really not that difficult compared to the intensive screening process that is involved with traditional life insurance coverage. You can get a guaranteed issue coverage up to $500,000 in benefit, or 2 times your income, whatever is greater. But you have to do that when you're first hired, right? And then you don't have to go through that statement of good health. So if you're someone who's thinking about joining Gartner and you are not insurable for whatever reason, then you really want to make sure that you're jumping on this benefit right when you start with the company, so you don't have to go through that statement of good health coverage, on the back end if you try to apply a year or 2 later. You do select your beneficiary when you do this, and you do that right in the Workday portal. That's different than a lot of your other benefits, like say the 401k plan through Fidelity Net Benefits. You go on Fidelity's website and you change your benefit there. With the life insurance benefit, you assign that through the Gartner HR Workday portal, and you will need a social security number when you fill that out. So it's really important that you make sure you do that correctly. Selecting your beneficiary and reviewing your beneficiary is huge. If this video is putting you to sleep, which I hope it isn't, now would be the time to wake up. Check your beneficiaries. If you have, and I've seen this before, your ex-spouse as your beneficiary, ex-boyfriend, girlfriend, if something were to happen to you, the person who's listed, that's who gets the money. You can see how that can be problematic. So you really want to make sure that you're labeling the right person. There are certain instances where you might want to consult an estate planning attorney, talk about maybe something along the lines of revocable living trust or some other entity that could accept money for your children until they reach what's called the age of majority. That might be a viable option to label as a beneficiary, but typically you put your spouse there. If you're not married, you can put someone else. Whoever's listed there, that is who gets the money. It's really, really important you do that right. Now let's talk about the cost. One of the only things they ask you in this is, are you a tobacco user or not? And there's separate pricing if you're a tobacco user. And as you age, the price for a tobacco user versus a non-user goes up considerably. The biggest thing to know with pricing on group life insurance, this is offered as a group plan for all people at Gartner, is the pricing is done in age bands. They are 5-year age banded brackets, as you can see from the graphic that I have below. This is taken right from the Gartner HR guide. So every 5 years, your price for coverage goes higher. And that's really important to know. So your cost doubles from the age of 39 to 40. $1 million at age 39 costs around $520 a year. Your cost goes up 50% in the next 5-year band, and another 66% on top of that increase from 45 to 49, and up from 60% again. So you can see this steep escalation. So the difference in cost from a 39-year-old to a 55-year-old is roughly 8x the price. So your $520 a year $1 million benefit, that same $1 million benefit at age 60 per se is $4,160, quite a bit more. So your price is not locked in, it's age banded. So as you age, the price goes up along with that. This is a beneficial structure in some ways, in that when you're young, especially if you have a young family and your need is really high, you can get up to that $3 million of coverage for a pretty reasonable premium. But as you age, that premium is going to be more and more costly for you. In my experience doing this for 15 years, many people don't actually realize what they're paying for this life insurance benefit, because it's just a little tiny line item broken out in their paycheck that's issued out 26 times per year. But when you multiply out that number over the course of a 12-month period, it adds up to being quite a lot. So it's something that you want to review. The pros and cons of group life insurance. The pros are it's a simplified issue. It's really cheap when you're young, as we were just discussing. The benefit increases over the years. As you get paid more, the benefit will go higher to match that, right? It's a multiple of your target income. So your price will go up with that because it's a price per $1,000, but it also increases as you age, the actual benefit itself. Inflation protected in a way, which is valuable. And it's done through payroll deduction, right? You don't have to write a check out every year. It's just attached to your payroll, comes right out. The cons are, it's hard to take the coverage with you if you leave Gartner. Gartner has a long history of keeping people for a long time, but if you did leave the company, it's hard to take with you. The age-banded pricing is a big deal. Again, it's pretty affordable when you're young, but as you age, it starts to become much less affordable. If you're healthy and you're young, or even if you're healthy at really any age, once you start to get over the age of 45, 45, you can start getting a more attractive deal potentially in the private insurance market. What makes it attractive is if you're healthy, you're guaranteeing and locking in your price at that good health rating. And health is the large determining factor in pricing out coverage in the private market. Age, of course, but also your health. If you have a super preferred health rating, your coverage could be half as much as someone that just has a standard rating. And if you get private policy, a term policy, for instance, you can lock in a set amount per years. 30 years was the max standard. Some companies now offer 40-year policies. That price that you pay in year one is locked in if you have a level term policy for that entire term period of, say, up to 30 or 40 years. You pay the same price, it never goes up, and you're priced at that good health rating. At my age, 36, am I healthier than I was at 26? Right? Like, not many people get healthier as they age. So you really want to lock in that good pricing, and it gives you flexibility in the future. It's not attached to your work, so it is portable. You can convert it potentially to a permanent policy if you needed that later on in your life. Really look into that, all the fine print if you are doing it, because it's not appropriate for most people, but something to consider. But more importantly is you lock in that coverage, you pay that same price, and when you start getting into your late 40s, 50s, and 60s, your price per thousand, if you're healthy, could be quite a bit less than what a group policy like the one offered at Gartner could be offering. But it is easy to do. It can provide you a lot of coverage. It's just something that you want to review. My big concern for most people when I look at their benefits from Gartner is not whether they have a private policy or group policy, it's just do they have enough coverage. Most people are really underestimating what it requires to replace your income if something were to happen to you and protect your family. And when we're talking about the cost, what it actually costs to protect that risk, not a lot considering how big of a risk it is. And that's what insurance is all about. It's catastrophic risk management. And of course, if you were to pass away or become disabled, those represent two catastrophic risks to your financial plan that really have to be addressed and can be done relatively inexpensively for how much of a risk that takes off the table. So with that, I'd really encourage you to review the group benefits that you have in place. Do you have enough coverage? What's your current health situation? Does it make sense to look outside of the group plan to get other coverage or add on to your group coverage potentially? All of those things would be part of a financial planning process that I would encourage everyone to undertake, because assessing how much coverage you need, understanding the right types that you should have, and what makes sense for you moving forward is a really healthy and important part of the financial planning process. So with that, we're going to wrap up our video today on supplemental life insurance benefit. It's a really important benefit, something that everybody should review at least every 2 years. Do you have the right types of coverage? Do you have the right amounts of coverage? Do you have coverage that you don't need anymore? That's part of the financial planning process and a healthy one. It represents a big risk. We want to make sure that we're managing that appropriately. And using a platform like Gartner's group life insurance coverage could definitely be part of that solution. I hope you found this video informative, and thank you for joining. Stay tuned for our next video on Gartner specific benefits available to employees.